Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Winter Webinar Series. This program is entitled Appreciated Real Estate Opportunities for Advisors. For those who don't know me, my name is Jonathan Shenkman, and I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One more quick note before I introduce our esteemed speaker, and that is that the handout to this program was sent out within the reminder email this morning. It will also be sent out again in the follow-up email tomorrow morning as well. Today, we're privileged to hear from Connor Barth from Sterling Advisor Solutions. Connor is a business and marketing analyst at Sterling Advisor Solutions. Sterling is a national leader in the CRT secondary planning for charitable remainder trust. In his role, Connor works on marketing materials such as hosting Sterling's weekly webinar and helping design the Sterling Advisor Guide series. He also works directly with advisors to discuss their client situations and help them find the best solutions for each unique situation. Connor studied economics at George Mason University. Today, Connor will be speaking on appreciated real estate opportunities for advisors. And with that introduction, I'll now turn the program over to Connor.
Well, thank you, Jonathan, and thank you everyone for joining us. So many of your clients own appreciated real estate, and some of that real estate represents an opportunity for both you and your client. There's opportunity for the client to lock in gains, reduce risk, diversify their portfolios, and if desired, create cash flow. There's opportunity for you to add value to your client and add assets under management. So we're going to walk through some of the main reasons clients sell and don't sell real estate. And we're then going to look at 6 of the most frequently talked about, if not actually used, techniques for selling appreciated real estate. And finally, we'll look at how you can select and implement solutions for your clients. So here are some of the most common reasons to sell. Most reasons to sell are either financial or personal. Personal reasons seem to be the most common in the real world, but I want to highlight a particular financial reason, risk, or more properly, diversification as a motive for selling real estate. So you know that any concentrated position, everything else equal, will increase a client's risk without any corresponding increase in expected return. And single parcels of real estate are like large single stock positions, except with less liquidity. And that means unwanted risk and sometimes hidden risk. So I want to direct your attention to that efficient portfolios graph. The horizontal axis represents risk. The vertical axis represents expected returns for a given risk level. Many or all of you will recognize the concept that as risk increases, so do expected returns. And if we look at that X, that represents a piece of real estate. An individual parcel of land is like an individual stock, likely to generate high returns at high risks. So we're actually dealing right now with a couple of cases in California, and one of them is an 81-year-old who's owned an investment unit forever. His basis is close to zero because of depreciation, and he wants to sell and diversify. Now, he made this decision months ago, but he's been sandbagged by California because the state still has pandemic measures in place, making it impossible for him to get the tenant out until maybe this year. Another case involves a very successful investment in a condo near the coast. The owner wants to sell to take his gain, but the condo association is blocking the sale. And again, completely unanticipated risk. It was a new condo association rule that is blocking him. So I guarantee you that neither of these investors even realized that they were taking these, out of left field risks. And as we so often see, many real estate risks are hidden. And these gentlemen certainly didn't get enough rent to compensate for these risks. So based on our conversations with many advisors and their clients, real estate represents too big a portion of the portfolio for a majority of clients who own appreciated real estate. Now, why do so many clients own too much real estate? So we think these are the main reasons. The green answers are what most people consider good reasons. The red answers are bad reasons, and then taxes are bolded in black. So we'll deal a great deal with taxes later, but the bottom line is most people with appreciated real estate own too much and hold on to it for bad reasons. Now, some of the most often heard reasons to hold on to real estate turn out to be either myths or are just questionable reasons used to justify holding way too much real estate. The facts suggest that real estate as an asset class is not lower risk, is not a good inflation hedge, and does not always go up in value. So this graph here shows the S&P 500, which is the dark line, and then the NAREIT All Equities Index, which is the pinkish line, since 1980. So in case you are unfamiliar, the NAREIT All Equities Index is compiled by the National Association of Real Estate Investment Trusts, and it represents all kinds of equity real estate, including apartments, shopping centers, office buildings, commercial, industrial, and special purpose properties. So the index is about as diversified as you can get within the real estate space. And even so, for the last 40 years or so, the REIT index has been about 36% more volatile than the S&P 500, despite how diversified the REIT index is. And individual properties, which is what most of your clients own, are impossible to measure for our purposes, but we all know that individual stocks on average are much more volatile than the index, and the same is almost certainly true for individual properties, like as our would-be clients in California are learning the hard way. So the data shows that real estate, even the most well-diversified real estate portfolio, is not low risk. Is it an inflation hedge? Well, we actually just finished writing a book on inflation, and that's a separate discussion. So if there is enough interest, we might be willing to do a webinar on that in the future. But if you were around in the 70s and 80s, you may remember hearing that real estate was a fantastic inflation hedge. And in the process of writing the book, we had occasion to examine that claim. And to our surprise, the data do not support the claim. So this chart shows the monthly returns to the REIT apartment index against the monthly change in the CPI. So if there were a strong relationship, meaning real estate is an inflation hedge, the dots would all line up, trending upwards and to the right. And that's not at all what we see here. So you may remember from your statistics class that R squared is a measure of correlation. If it's exactly 1, then there's perfect correlation. If it's 0, then there's no correlation. And this graph looks like the textbook case of 0 statistical relationship. So the data show that real estate is not an inflation hedge, at least over any reasonably short to medium term. So what does drive real estate? Interest rates. So let me explain what we're looking at here. The vertical axis represents the absolute level of the Wilshire Total Real Estate Index, not adjusted for anything. The horizontal axis is the 30-year mortgage rate in percent, and then the pink purple curve is a purely theoretical multiple of cash flows based on the interest rate. The actual level of the curve is irrelevant, but the shape of the curve certainly is relevant, and it's no coincidence that the shape of the pink line and the blue dots are the same. We know theoretically that real estate should be very sensitive to interest rates, and looking now at this empirical data, we can say that in both theory and in the real world, everything else equal, higher interest rates mean lower real estate prices. And so now, moving on, the Case-Shiller Index is a widely known and well-respected index of house prices in the United States. So this graph is of nominal values, that is not adjusted for inflation. The vertical axis here is logarithmic, which allows us to see the several episodes when even nominal prices went down or failed to go up. And we can see by looking at the graph that real estate dropped in value during the financial crisis about as much as it did during the Great Depression. So the verdict is that real estate does not always go up. And now here is the same data adjusted for inflation. And it tells us a couple of things. So for a long time, up until about 1990, things were not very active. Then in the late 90s, the dot-com bubble collapsed and interest rates were cut. This created the housing bubble that eventually crashed and led to the financial crisis. So houses are not a very reliable inflation hedge. They're not low risk, and real estate does not always go up, except perhaps over a very long time horizon. Now, this slide shows the Case-Shiller Home Price Index for the whole country. The red circle in the middle is the peak before the financial crisis. And the $64,000 question is, are we at another peak? And if there's any opportunity to take excess risk in real estate, we really think now is the time to do so. So we are now going to take a whirlwind tour around the perimeter of the country. So each graph is a local market with actual values shown against a fitted log linear trend. So notice how each market is looking expensive. Here's Boston, Miami, Houston, San Diego, Seattle, and there's Chicago. You can see that things are looking expensive. So moving on, the big reason people don't just sell and take the risk off the table is that bolded reason we spoke about earlier, which is taxes. So this slide illustrates the many income taxes that eat into the gain when real estate is sold. So we start on the left with a $3 million gain. Then federal capital gains tax takes a chunk. Most investment real estate has been depreciated, and depreciation is recaptured on sale. Recapture is taxed 25%, not 20% like capital gains. And then since 2013, the Obamacare surtax, or also called the net investment income tax, has added 3.8% to the tax bill. Then 41 states have an income tax, and the average of those rates is about 6.5%. So a typical person then would keep just over $2 million of a $3 million gain. And that is the major reason people who should sell don't sell. So it looks pretty clear that no planning means very high taxes, but better planning can mean lower taxes. So now we'll take a look at a few different planning strategies. So here, the simplest strategy is to accept that taxes will cut into your gain. So you could simply just sell and pay the tax. So here's our $3 million gain without recapture and with state income taxes for a variety of states. In California and New York, the total tax can easily exceed a third of the gain. So now let's look at some actual approaches to tax savings. An installment sale spreads the gain over more than 1 year. The tax saving results only if some income is moved into lower tax brackets. And so while tax is deferred, so is receipt of cash. So really the only real benefit is here is moving into a lower bracket. When you sell real estate through an installment sale, you sell the property, but instead of getting cash, you get an installment note from the buyer. Now that can create additional risk because that means you're potentially exposed to the buyer's credit. And if the property goes down and the buyer doesn't pay, you get back a property worth less than before. So installment sales involve a number of limitations which should be carefully considered before engaging in one. So here are some numbers showing how an installment sale could save taxes on a $3 million gain. The box on the upper right shows federal gain only, and we don't talk about recapture here because installment sales don't help with recapture. A straight sale would result in about $667,000 of taxes. Spreading the sale over 4 years would result in about $568,000 of taxes. And then if the sale were spread over 6 years, so each year all the income is coming in less than the highest bracket, the total taxes would be about $484,000. So the total potential tax savings on a $3 million gain is about $180,000. That's only about 6% of the gain. And if the seller has other income, the benefit, if any, will be even smaller. So another strategy involves Section 1031 of the tax code. This section of the tax code explicitly permits tax-free exchange of qualified real estate. When done right, it is an extremely useful technique commonly used by professional real estate investors. The buildings pictured here were involved in one of the largest 1031 exchanges. Hudson Waterfront Associates avoided perhaps $500 million in taxes when they exchanged their buildings for some San Francisco properties. So 1031 is great for professional real estate investors who want to remain active in real estate, but doesn't work for principal residences. It's complex and really has to be handled correctly. After the first property is sold, the new property must be identified within 45 days. Now, that doesn't always happen. So enter the Delaware Statutory Trust. A Delaware Statutory Trust is a creation of Delaware law. Revenue Ruling 2004-86 declared that qualifying Delaware Statutory Trusts can serve as replacement property in a 1031 exchange. So many smaller investors sell their property in a 1031, and then they'll get units in a Delaware Statutory Trust in return. Delaware Statutory Trusts are typically offered by a promoter specifically as replacement property in a 1031 exchange. But they are a limited tool. There's lots of rules, little flexibility, little control, and they can be very expensive. We've seen them where related party advisory fees are over 10% of revenue, and that's before the operating fees. So we believe they are best used to rescue a 1031 that would otherwise fail, and even then used with caution. So the next technique is the UPREIT, or the 721 exchange. The Taubman Center's IPO brought the UPREIT structure public attention in 1992. Now they're pretty complicated, so since then their popularity has waxed and waned. If you have qualifying property and can identify a REIT to do an UPREIT transaction with your property, it works like this. So the property owner contributes property to an operating partnership. That is not taxable. The property owner gives up control and receives operating partnership units in exchange, and these will have their own management to deal with and expenses. And the property owner gains some diversification benefit, but just within real estate. Eventually, the property owner can exchange the operating units for REIT shares. So if the REIT is public, the property owner can sell the shares, and that exchange is taxable. Now, there are a number of potentially significant limitations on the usefulness of UPREITs, and some of them are listed here. We believe this is a transaction mainly for very knowledgeable professional investors. Another strategy is setting up a 664 real estate shelter trust. It is a tax-exempt trust. How it works is the property owner contributes property to the trust in exchange for an income stream. The income stream can last for the property owners and spouses' lives, and often for the lives of their kids, and sometimes even all or part of their grandkids' lives. We typically see trusts with expected trust terms of 50 to 60 years. The contribution is tax-free, and in fact, the property owner even receives an upfront income tax deduction for part of the market value of the property. The trust then can sell the property, and the trust pays no tax. The trust places the cash from the sale into an investment account, which is managed by an investment advisor. And most of our clients like to set it up where they will receive 5% annually from the trust. Now, that 5% annual income is taxable to the recipient, but that 5% can be deferred. And if it is deferred, it accumulates and grows tax-free and can be taken at a later date. So this diagram shows most of the same information a little differently. So on the top left, $3 million goes in, $3 million is sold, $3 million is invested, no tax. The property owner receives an income tax deduction of about $300,000. And then each year, the owner and spouse receive income of 5% for life. That can be deferred and compounded tax-free inside the trust. And people can defer for very long periods too, 20 years or more if they want. And then after the owner and spouse are gone, the kids or whoever else they choose to name as a beneficiary of the trust, they get to receive the income. And depending on everyone's ages, even grandkids can be in line because, as I said, the average lifespan of a 664 trust is 50 to 60 years. So here's a comparison of a 664 trust with an outright sale using our $3 million property. Now we've thrown in some basis and some recapture. And so the top green line is the value of the trust account. Now that's the investment account. The bottom red line is how much would be in the investment account if the property were sold outright, the taxes paid, and then the remaining money reinvested. To make the comparison apples to apples, we've made the annual net after-tax spending equal in both scenarios. Well, equal, that is, until the red scenario completely runs out of money. So the annual distribution is 5%. We've assumed growth of 7%. We've also charged the green line, or trust, an extra 50 basis point fee that's not charged to the red line. And despite that, the trust grows and the other one doesn't, because the trust starts off with almost $1 million more. That's a lot of money to produce growth and to compound. And now here's the same thing, except we assumed that the property owner defers all spending except taxes for the first 10 years. And still, the green line ends up with way more. So now some of you may think that a 664 trust sounds like a typical charitable remainder trust. And you would be right that charitable remainder trusts are described in section 664, but traditional charitable remainder trusts have largely been promoted by charities, and charity wants its money as soon as it can get it. We looked at it from the point of view of the property owner and built a 664 trust that is designed for the property owner, the wealth producer, first. So, while the charity wants its money as soon as they can get it, our trust typically lasts 50 to 60 years. So we think the traditional charitable remainder trust bears about the same resemblance to a 664 real estate shelter trust as a World War I biplane does to a modern jet fighter. So a 664 real estate shelter trust, like any option, has some limitations. The main one for some people will be that they give up access to the principal. Others include that the trust is irrevocable, does require professional administration, mortgaged property may need to be restructured before putting it in trust. A principal residence is often not a good choice of property if the owner wants to continue living there. And the income is taxable when it's paid out, but offsetting this are a number of benefits. So in addition to the big tax benefits, there's quite a bit of flexibility to take income or defer. So the investment advisor can also invest in a wide variety of things. If an investment works for an IRA, it probably works for a 664 trust. And then assets in a 664 trust are also protected from creditors. And another key feature where a lot of folks like it is when they have a kid or a grandkid who they are worried will blow through the money. A 664 trust prevents that. So on balance, a 664 real estate shelter trust is a great solution for many property owners. So we've covered a lot of ground. This table summarizes the main comparisons, and we are going to send around the slides, so you don't have to review every box right now. The main takeaway here is if a client wants maximum flexibility and is willing to pay the tax, then just sell, pay, and go home. But if a client wants maximum flexibility without having to pay the tax, a 664 real estate shelter trust looks pretty good. And so now here's a quick look at when to use each option as a refresher. The outright sale is good if a client doesn't really care about the taxes. You can just sell, pay, and move on. Installment sales work best when the amount is relatively small, when the client has little or no other income and doesn't mind waiting years for proceeds. 1031 is really best for heavy hitter, well-advised real estate professionals. A 721 or UPREIT is a specialized solution that works best when just a number of factors all line up. And then a 664 real estate shelter trust works best in situations where the client doesn't want to pay the tax, but does want to diversify out of or partially out of real estate. So there are a number of situations where the 664 real estate shelter trust could work. Of course, it works for apartment buildings, raw land. It's great when you have a property owner that's old and wants to sell out of their position. They're tired of the hassle of owning it. So this could work for pretty much any kind of property in a number of different situations. So as I said, we are going to be sending around these slides, and we have a form that you could fill out. But if you would like us to take a look at any real estate cases you have in mind, we'd be very happy to provide you with some pretty accurate analysis that you could share with your client. We would just need to know the approximate market value of the real estate, the approximate basis, the amount of debt, if any, the ownership method, the owner's main goals, and then if there is a spouse, children, grandchildren. And for each situation you want, we'd be happy to provide you with some analysis like that depicted on the screen. We'd be very happy to consult with you, discuss, review. And if you want, we have turnkey documents to put a 664 real estate shelter trust in place quickly and cost effectively. So this concludes the real estate aspect of the presentation. You may be interested in other aspects of Sterling Advisor Solutions. So this is an overview of our solutions map. You can see that we spent a good amount of time here discussing just that one circled aspect, but we can also help with a wide variety of client situations, most of which involve carefully crafted, effective solutions that will help you gather more assets, keep more assets, get and keep more heirs as clients too. And here are some examples of advisor materials that we have available on a variety of subjects. We also have a growing library of additional materials, including content like hardcover books. The one pictured here is that book about inflation that I was talking about earlier. If you want, we'd be very happy to have you write a foreword for the book. You could get your name on the cover of the book as the author of the foreword. And then if we partner with you, we'd be very happy to provide you with copies of the book with your foreword and the name on the cover for free. And then we find that it works best for your clients, for you, and for us when we've established a real working relationship. To that end, we've established a strategic growth partnership program. So if you qualify and become a partner, you will gain preferred access to all of our solutions, consulting, advice, and marketing materials. The brochure shown explains the program in detail. So if you're interested, reach out to us and we'd be very happy to send that your way. And now here are the best ways to contact us. I thank you all so much for your time, and I thank Jonathan for offering us this opportunity to speak to all of you. Hope we can speak soon.
Great. Thank you so much, Connor. And if anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, you can feel free to reach out directly to Connor or myself where appropriate, and I'll be sure to include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my winter webinar series continues on Thursday, February 16th, featuring Matthew Rappaport, Vice Managing Partner of Falcon Rappaport in Berkman, based in Long Island, New York. He's going to be speaking about taxation of cryptocurrency, NFTs, and decentralized finance. And I'll send out an invitation to this and all of my upcoming webinars after the program. Second, if you or a colleague would like to be kept abreast of my latest articles, webinars, and all the other work I put out, you can sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. You can also follow my work on Twitter, YouTube, and Instagram at Shenkman on Money. Finally, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. And I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.